Mortgage rates are sitting in the low sixes, and for a lot of people, that feels like nothing's really changed. Buyers feel stuck, sellers still feel hesitant, and most headlines are acting like the housing market is either crashing or it's frozen. They pretty much will just tell you whatever they can to get you to stick around for the ad. But when you look at what buyers and sellers actually did in January, the market is already shifting in ways most people aren't really paying attention to.
Tell me more. Tell me more.
All this covered in this week's National San Diego Market Matters, and I'm Karl, your San Diego realtor. Now, if you find this kind of market breakdown helpful, make sure you like the video and subscribe to the channel. And if you're thinking of buying or selling here in San Diego and you want to talk through your situation, my contact info is always linked in the description below. I've been helping buyers and sellers here in San Diego since 2004, and I'd love the opportunity to help you with your next move. In this video, we're wrapping up January by breaking down the latest national housing data, not to make emotional predictions, but to understand what buyers and sellers are actually doing and what that tells us about where the market may be heading next. Mortgage rates are where most people feel the housing market first, so that's where we're starting our data review. As of the end of January, the national 30-year fixed mortgage rate is sitting at 6.16%. The 15-year loan is coming in at 5 3/4, and jumbo loans are approaching the mid 6% range. A jumbo loan being any loan over $830,000 at the time of shooting this video. Now, the bigger story isn't what rates are exactly, it's why rates continue to feel stubborn and stuck, even as the economy is sending us these mixed signals.
Signal? What signal?
Look it.
To understand that, you have to look at the spread between mortgage rates and the 10-year Treasury. At the end of January, the spread came in at 1.82%, roughly down from 2% at the start of the month. And that's a meaningful improvement there. This time last year, the spread was closer to 2.3%, which reflected a much more stressed and defensive lending environment. Historically, a normal mortgage to Treasury spread sits between 1.5% to 2%. So we're now back in the middle of the norm. And that tells us that the mortgage market is stabilizing. Lenders aren't panicked or stressed the way they were last year, but they're also not confident enough to aggressively compress margins. And a big reason for that is that inflation has ticked back up and rate cuts are currently on hold. And here's why this matters for you. Even if Treasury yields drift lower, mortgage rates won't meaningfully fall unless lenders feel comfortable tightening that spread. The spread is essentially the market's risk buffer. The wider that buffer is, the more expensive mortgages stay, even if interest rates elsewhere are coming down. When inflation is sticky and the Fed is paused, that buffer stays wider, which keeps mortgage rates from dropping as fast as people want. And this is where the Federal Reserve leadership becomes relevant. President Trump has nominated Kevin Warsh to replace Jerome Powell as Fed chair when Jerome Powell's term ends in May. Warsh has historically leaned hawkish on inflation and critical of excessive stimulus, but more recently he has expressed openness to lower rates if inflation cools and productivity improves.
Thank you, Jesus.
Markets are still trying to decide which version of Warsh will ultimately lead the Fed, and that uncertainty matters because mortgage rates are set by markets, not headlines, and markets hate uncertainty. Bond markets care about this deeply because credibility and discipline at the Fed directly affects long-term yields. If investors believe inflation control remains the priority, spreads can continue to normalize. But if inflation stays sticky or political pressure clouds the Fed's independence, bond markets are going to push back, keeping mortgage rates elevated even without formal rate hikes. So right now, the data is telling us this: the mortgage market isn't broken, but it's cautious to say the least. Inflation isn't fully beaten, rate cuts are paused, the spread is improving, but it's not collapsing. And that's why mortgage rates feel stuck in place instead of falling quickly. So we aren't expecting much to happen with rates in the near future that will be meaningful for your mortgage payment. Now let's talk about how buyers are actually responding, because this is where theory actually meets behavior. One of the cleanest demand signals we have in real estate is the Mortgage Purchase Applications Index. This tracks how many people are actively applying for mortgages to buy homes, not to refinance, not to speculate, but to buy. Over the past year, higher mortgage rates kept applications lower, and that did two important things at the same time. It contained price growth, and it forced buyers who were priced out at 7% interest rates to slow down. They grew their income and they built their savings. That pause wasn't a bad thing. It created more prepared buyers, not fewer buyers. Now, fast forward to late January, the purchase application index jumped up to about 194, which is one of the strongest readings we've seen in quite a while. That line moves up almost perfectly with where rates are today. We're no longer near 7%. We're sitting in the low 6% range, if you can remember. And that's enough to pull a meaningful number of those sideline buyers back into the market. This is an important reminder though. This is, again, national data. There are absolutely markets around the country that are seeing low buyer demand right now and others that are still seeing massive buyer demand. The purpose of this data is to give us a broad sense of what the country as a whole is experiencing, not to explain what's happening in every micro market. This is exactly why I separate these conversations. National data helps us understand the direction of demand and sentiment. Local data tells us how that actually shows up on the ground. And if you want to see how this is playing out specifically here in San Diego, that's what I'll be digging into next week. So make sure you subscribe to the channel so you don't miss out on that video. The big takeaway here is simple. Demand doesn't need rates to crash to come back. It needs stability and some modest improvement. Buyers have been waiting, watching, and preparing. And when the math starts to work again, then they move forward. Before we move on, it's worth slowing down for a moment on national single-family inventory, because this is the constraint shaping everything we're seeing. Inventory grew meaningfully through most of 2025, but it peaked late in the year and has just rolled over as we entered into 2026. We're no longer in an environment where supply is expanding month after month. That shift matters because buyer demand is starting to rebuild at the same time that inventory growth is kind of slowing down. When inventory is rising, buyers can take their time and price stays contained. When inventory flattens or contracts, kind of like what we saw at the end of 2025, buyers are forced to compete more directly for what's available, even if demand hasn't fully recovered yet. And that's the key distinction here. Inventory isn't collapsing nationally, but it's no longer providing the relief the way it was earlier last year. The market is tightening at the margin, which limits how far demand can rebound without creating pressure. And that brings us into new listings because inventory doesn't change unless sellers are stepping back into the market. If new listings don't accelerate, inventory stays constrained, and that's where the real story of early 2026 starts to take shape. Moving into national single-family new listings, this is where seller behavior shows up in real time. January started off slow, which is normal after the holiday, but over the following 3 weeks, we saw a noticeable pickup in new listings. That kind of acceleration this early in the year is a bit atypical, especially considering that there wasn't any major economic events or anything forcing sellers into action. What's important here is context. 2025 closed out very comparable to 2023 and 2024, and January 2026 is starting off from roughly the same baseline. This doesn't look like a market resetting or unraveling. It looks like sellers who have been just waiting and are finally ready to test the market as mortgage rates have stabilized in the low 6% range. Now, when people see listings rise like this, the natural concern is that homeowners are being pushed to sell because they can't afford their homes anymore. That's reasonable assumption, but the data doesn't support that as an explanation here. This is where price reduction data helps us separate the stress from the strategy. Right now, 33.6% of single-family homes nationally have had recent price cuts. That's elevated compared to a very tight market, but it's actually much lower than we saw in most of 2024 and well below the pressure we saw back in 2022. If sellers were being forced into the market, we'd expect price reductions to be rising much more sharply. Instead, they're staying relatively stable. When you put these two charts together, the story becomes clear. Listings are increasing, but sellers aren't panic pricing. They're entering the market intentionally, setting expectations, and adjusting only when necessary. That's not forced selling, that's price discovery, if anything. And that distinction matters a lot for where prices and negotiations go from there. Now, when you step back and look at all of this data together, a clearer theme emerges. Buyer and seller sentiment hasn't disappeared. It's just become more selective and more patient. Keyword there. Buyers are still out there. Mortgage applications are rising, pendings are holding up, and demand is responding the moment the math starts to make sense. At the same time, sellers, they're not rushing in out of fear. New listings are increasing, but price reductions remain controlled, which tells us that this is intentional participation and not distress. Now, heading into Q1 of 2026, this sets up a market that's not flooding with options. It's full of cautious buyers and sellers and very price sensitive, to say the least, probably. We're not seeing the conditions for a breakout surge, but we're also not seeing the ingredients for a breakdown. If inventory stays constrained and demand continues to build slowly, prices are likely to hold steady with pockets of competition where the numbers work out. That's the market we're walking into. It's not frozen, not overheated. If anything, it's just patient. And understand that gives you a real advantage whether you're buying, selling, or deciding to wait. And that's a wrap for this week's San Diego Market Matters. I hope that this data helps you make a more confident decision about your next move. Now, if you have any thoughts, questions, concerns, don't hesitate to reach out. And if you found this helpful, make sure you like the video and subscribe to the channel. As always, I'm Karl Kyler, your San Diego Realtor. I'll see you in the next video.